market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Jumana Bersace in Dubai, filling in for Francine Lacroix today. Let's start with that breaking news on European PMI numbers and bring in Bloomberg's Alex Weber. So, Alex, just looking at this, we have seen a jump in the composite PMI higher than forecast. Talk us through these numbers.
Yeah, the headline number is certainly reassuring. It confirms that we're sort of gradually continuing to grow in the Eurozone. But I think the real takeaway from today's numbers is when you look at the manufacturing sector, especially in Germany. And there the PMI indicator jumped to above 50. That's the level that indicates growth for the first time since 2022. So that's a real milestone that we've seen here. And that's obviously because of the massive government spending we're seeing in infrastructure and defense. The advance in the index was driven by new orders. So that just shows that this whole transmission of fiscal policy is starting to work. And it should translate into higher growth for Germany and for the broader Eurozone. Yeah, pretty remarkable that Germany's manufacturing sector grew for the first time since 2022. It's been a really long time since the manufacturing sector actually grew in Germany. What does this all mean, though, for the European growth outlook as a whole? So for now, I would say it mostly confirms the assumption that we're going to see a pickup, especially in Germany. Germany only grew 0.2% last year, and that's expected to pick up to somewhere around 1%, somewhere north of 1%. So you need to see this kind of momentum for that to become true. We've already seen some signs in the factory orders at the end of last year. Now we need some further confirmation from production numbers. We're also going to have new business sentiment surveys on Monday. Those have tended to be a bit more negative. We're going to see if those pick up as well. And then this should also translate into a somewhat stronger growth for the Eurozone in the coming quarters.
Bloomberg's Alex Weber, thank you so much for bringing us the latest on those PMI figures. Let's turn to geopolitics now. A growing contingent of U.S. military forces in the Middle East is escalating tensions in the region once again, as the U.S. president ramps up pressure on Iran to strike a nuclear deal. President Trump has now signaled limits to the diplomatic process, setting a 15-day deadline for Tehran to reach a deal. Let's speak to Ziad Dawood, chief emerging markets economist for Bloomberg Economics. Well, Ziad, there's been days of speculation now that the U.S. are readying themselves for an attack on Iran. And I think the president was pretty explicit. He's essentially said there's a 10 to 15-day window in order to get a deal done now.
Yes, Jumana, I don't know, will it be an understatement to say that something serious is simmering here in the Middle East where we are? I think if you look at what the US is doing, it's amassing the largest military mobilization since the invasion of Iraq in 2003. We have the 10 to 15-day deadline from President Trump to Iran. And there were news reports about, the US strikes on Iran would be long, would be big, and will come sooner than we might think. And if you look at the Iranian side, they're not de-escalating either, right? Yeah. So they're doing military drills that are resulting in a temporary closure of the Strait of Hormuz. The Iranian leadership is saying if there are strikes on Iran, they're not going to stay in Iran, they're going to spread to the wider region. It's hard to escape the following conclusion, that the US strikes on Iran are probably going to come, and that the Iranians will probably not limit themselves to symbolic attacks like they did in the past.
Okay, well, words of foreboding there. It's interesting because most of the times, and you know this, whenever we have a geopolitical flare-up in the region, markets tend to react very briefly and then move on past it. But I wonder whether this time may be different, and whether actually, if there is a serious regional escalation, I'm not just talking about Iran, whether there could be implications for the global economy at this point.
Yeah, what has happened, the translation from Middle Eastern geopolitics to the global economy happens through oil. And what we've had in the last 2.5 years, we've had unimaginable escalation on the geopolitical side in the Middle East. Things that we didn't imagine would happen did happen. And on the other hand, oil prices are $20 lower than they were before October 7th, 2023. Yeah. The question is, Iran will put this to another test. A US strikes on Iran will put this to another test.
Yeah.
And markets currently are not pricing zero geopolitical risk premium. We track this on a daily basis, and we estimate that markets are probably pricing in $5 into each barrel of oil as a premium on Iran.
Yeah, I do want to ask you, and we have an oil segment coming up, but just with the lens of an economist hat, how influential this region is looking ahead in terms of the marginal price of where oil trades? Because, you could make the case that the U.S. has become a lot more independent in terms of where its oil needs are derived from. Most of it is coming from domestic production. And so actually, the situation today is very different from how it was historically in the past in terms of the ironclad holds that this region, specifically Iran, might have over oil markets.
True. Let's look at oil and then look at the energy mix. If you look at oil alone, Iran produces about 5% of global oil supplies. The region as a whole, once you include Iraq and Saudi Arabia and Kuwait and the UAE, we're talking about 1/3 of global oil supplies. And that's oil. Now, you might argue that oil is becoming less important as an energy sort of input to the world with the rise of renewables and other items. If you add up the oil and gas that comes from the region, and you look at as a share of the total energy mix, the region provides or supplies about 15% of the global energy needs. That is unchanged from the 1970s. Yes, oil is becoming less important, but gas is becoming a more important energy input, and the region is producing more of it. And guess where it's coming from? It's coming from one oil field that's shared by Iran and Qatar.
Okay, well, there you go. I got my answer then. Ziad, thank you so much. A chief emerging markets economist for Bloomberg Economics. Well, let's talk more about oil prices, which have risen some 6% over just the last two sessions on those U.S.-Iran tensions, sitting at a 6-month high now. Joining us is Anthony DePaula, our Middle East energy markets reporter. So, when I look at the price of oil here, I just wonder how much of this geopolitical premium is accounting for an actual potential hit to Iranian exports versus an actual potential disruption to the Strait of Hormuz? How are oil traders thinking about this?
Hi, Jumana. Good afternoon. Yeah, I would say that I would put the hit to exports and the hit to production kind of in that same risk basket. And I don't think we're seeing that in the oil price yet. I think what we're seeing right now is a risk premium related to the risk of this elevated tension, the risk around the probability that something is likely to happen, as you just had Ziad on talking about. So we've been hearing from investors and analysts and traders that they're looking at something on the low side, a $3 to a $10 on the high side risk premium related to the possibility of some kind of activity, some kind of attack in Iran. And that's what we're seeing now, pretty much the high side of that risk premium in prices right now from where we started when we started looking at prices at the start of this latest escalation. So while we're at that peak of that risk premium, if we do get some actual attack and we get some actual impact on production or exports, oil is going to shoot above that. We will see a spike if there is an attack, and if there are reports of any infrastructure being hit. We've not only got the risks to the Iranian infrastructure and the exports, but also the risk of what will be an Iranian retaliation and whether that hits other oil producing and exporting infrastructure in the region, in countries like Saudi Arabia, the UAE, even Iraq. So those countries are all potentially at risk if there is a bigger Iranian retaliation than we saw in June. So these are all factors that could push the oil price even higher than where we are now, Jumana.
Yeah, so it's not just the first derivative, the second derivative as well needs to be accounted for. But Anthony, if you rewind back to last June, if you think about, OPEC Plus and how much the group has actually put back in terms of extra oil production to the market, this time around, how much spare capacity are they actually sitting on and are capable of supplying the market with, should there be a big disruption coming through from Iran?
Yeah, well, this speaks to, I think, kind of that question that you were talking about before about how influential the Middle East is in terms of oil markets. And the Middle East is still influential because they are that swing producer. This is the region where they keep oil supply fallow, say, not being produced, so they can bring it back to the market at a time of emergency. Of course, as OPEC Plus increases production, that cushion of unused spare capacity gets smaller and smaller. And really, we're talking about that cushion being the smallest that it's been in a long time, because as OPEC Plus has increased the production through the autumn. Right now, they're in a pause period during this first quarter, so they're not increasing production at the moment. But Saudi Arabia is up to about 10 million barrels a day of production out of a overall sustainable capacity of 12 million barrels. So that leaves them that 2 million barrel a day cushion, which is not enough to replace Iran's production, which is much higher, over 3 million barrels a day. Plus, if you do see some impact on exports from this region, of course, Saudi Arabia, the UAE, Iraq, they all export through the Persian Gulf, through the Strait of Hormuz, which Iran threatens to close, to block again and again. It has never happened, but that's always a risk that the oil market is looking for. So that spare capacity has been reduced a little bit. Most analysts and traders will think that the UAE is producing above their quota, so that limits their spare capacity. So really, when we look at spare capacity, we're looking mainly at Saudi. It's about 2 million barrels a day. The oil market will react negatively, meaning price going up, if there is any hit to production or exports. And then it will probably have another additional negative reaction, meaning potentially higher prices, if it sees that spare capacity too tight to meet that demand. So we are kind of in a period where the spare capacity is tight. At the same time, under normal market conditions, as you and I have talked about over almost the last year, we've been looking at a glut in the oil market. That has kind of been canceled out because we've got all this geopolitical risk on the price right now.
Yeah, absolutely. And not many people saw this coming. Anthony DePaula, our Middle East energy markets reporter, thank you so much. Well, Anglo American investors are focused on the miners' combination with Teck Resources to create one of the world's biggest copper mines. The CEO, Duncan Wanblad, spoke to Bloomberg earlier about expectations for the merger.
Our expectation was that the time to completion would be somewhere between 12 and 18 months. So that would put us somewhere between September of this year and March of next year. And I believe we are absolutely on track as far as that's concerned. So we have had no indications from China, either positively or negatively. We are in a process with China, and this is moving at the speed and the pace that we expected it to do.
On the diamonds business, on De Beers, Duncan, you talked about the complexity given the market. What is your sense as to where we are in the market journey, where we are in terms of that competitive threat, the softness in the Chinese market? When do the conditions become good to get this across the line?
Yeah, look, a number of things are sort of impacting. I think this time last year I said, well, we were slightly hopeful that we were starting to see some green shoots insofar as we were starting to see a net positive inflow of diamonds back into China. We were seeing very, very robust activity for polished goods in India, and the US was stable to improving. So these are three key big markets for diamonds. But at the same time, of course, we saw massive production increases, particularly coming out of Angola during the course of the year, which put quite a lot of pressure on pricing. And at the same time, the lack of a trade deal between the US and India resulted in a 50% tariff on all Indian goods, and the vast majority of rough diamonds go to India for cutting and polishing. So those were sort of the impacts during the course of the year. But the fundamentals in terms of what changes diamonds, I think, is just the time it takes for these hopefully this trade deal to be done, but secondly, the time it takes for consumers to fundamentally realize the difference between lab-grown diamonds and natural diamonds from a value perspective, and certainly we are seeing that today.
That was Anglo American CEO Duncan Wanblad speaking to Bloomberg earlier. Well, coming up, we discuss risk-off sentiments as well as the Fed and the AI trade with Lale Akoner, global market strategist at eToro. This is Bloomberg.
February 24th, as affordability, immigration, and national security dominate the headlines leading into the midterms, President Trump will deliver his State of the Union address. Balance of Power will bring you live global coverage starting at 8 p.m. Eastern.
You are watching The Pulse. I'm Jumana Versace in Dubai. Now, oil rose to a 6-month high and stocks trimmed losses as escalating tensions between the U.S. and Iran weighed on risk sentiment. Joining me now is Lale Akoner, global market strategist at eToro. So, Lale, I'm going to start with just the geopolitical developments and whether one should be heading into the weekend concerned about the real possibility of military action in Iran and how you're thinking about it from a market's perspective. Should people be hedging for a potential escalation here?
Sure. Look, the market is thinking that this is a negotiating tactic. Obviously, it's creating demand for safe haven assets, such as the U.S. dollar. I think that will continue heading into the weekend and maybe next week as well. Expect more increase in price of gold and other sort of like more safe haven assets. So, and of course, it will create volatility in the markets, and that's expected.
Yeah, I mean, the main winner always seems to be gold in this situation. No matter what happens, uncertainty anywhere, gold seems to be a winner. But let me just talk to you about the recent batch of data that's come through from the U.S. Surprising to the upside. We had an upside surprise on the labor market data. And then the Fed minutes this week, also quite hawkish as well. How do you think that creates a setup going into the second half of the year with what will be a new Fed chair and pressure on the Fed chair to cut interest rates?
Sure. Look, I think for rate cuts, more or less, we're expecting 2 rate cuts. I don't think the new Fed chair does change that scenario much, but I think what it changes is the fact that he really doesn't like QE, that he wants to see a tighter, a smaller Fed balance sheet, and therefore that has implications that will play out in the next few years. It cannot play out in a short period of time because it would create funding stresses in the markets and volatility and sell-off as well. But it's quite important. So what we're saying is that, you know, for him to be able to pursue quantitative tightening again, he needs to make sure that financial deregulation is going to be in place, which I think is going to be the theme this year, for them to be able to, again, increase banks' balance sheets, where banks can take on, say, more long-duration treasuries and maybe even MBS. So I think this is the story for the new Fed chair. Regarding the data, I think that, you know, soft landing still intact. It could be the case that if oil prices stay elevated for longer, that would spill over to long-term inflation expectations and therefore might complicate Fed's reaction function. But it's too early to say that is going to be the case. Again, what we know so far is that this is a negotiating tactic.
Yeah, the other thing I've been watching this week is just how well the greenback has performed. And for once, you are actually seeing money go into the dollar with the uncertainty in the air. It is acting like a safe haven, the best week, I believe, since October. Do you think the decline in the greenback is coming to an end now because of, you know, the reasons that you just cited as well, potential quantitative tightening alongside a slightly more hawkish leaning Fed?
I think it will stay soft, Jumana, for some more time. Again, it's very much tracking what we've seen Trump 1.0, where it's declined by around 10% since the beginning of 2025. So I would say that, you know, downward pressure coming from the rate cutting cycle is going to impact the U.S. dollar. And let's not forget this administration wants a more sort of like competitive U.S. in terms of trade, right? But at the same time, they don't want to lose the U.S. dollar's reserve currency status. They don't want to lose its sanctions role as well. And therefore, they are managing that depreciation. However, as you said, come second half of 2026, we might see some elevated pressure on the U.S. dollar, but I don't expect it to be nowhere near 2022, 2024 levels.
Yeah, and, you know, it's interesting what you say about the U.S. administration actually advocating or wanting a weaker USD because, in theory, it should help with trade. But actually, if you look at the trade deficit numbers that came through yesterday, the trade deficit, U.S. aggregate trade deficit for 2025 was just as big as it was in 2024. On the flip side, this morning, you're looking at a massive UK surplus. And I think, it really just goes to show how the difference in the budget situation can actually influence where our currency is heading. I'm curious to see how you're thinking about the pound from here. On one side, perhaps you've had the weakness of the USD play out, but on the others, you have, the better budget dynamics. At the same time, a Bank of England that's likely to start cutting in the next month.
Correct. We do expect the Bank of England to cut. I think inflation numbers are heading in the right direction, and that will put some pressure on the sterling vis-a-vis the US dollar. Now, for trade deficit, of course, these things play out over multi-periods. So it's not going to be the case that, the Trump administration is pursuing a competitive trade agenda, and therefore you will see that coming to the data right away. It's not going to play out right away. I think it's going to play out over a period of time, and therefore the impact on the US dollar as well.
Yeah. What is your read of the earnings season, respectively, that we're getting between the U.S. and some of these European markets? Because, again, you could point to the data suggesting that the earnings growth actually is coming through from the U.S. and not in Europe, but European markets are outperforming.
Sure. I mean, U.S. Earnings growth is around 14%, which is healthy. Again, it's very much driven by tech, communication services, industrials. Although when you look at the beats, you see that, beats are lower than what we've seen in the past few quarters. So it really tells me that actually the environment is coming to a point where, for instance, investors will be more discerning in terms of not really rewarding last year's spenders for this year as well. They really want to see execution, especially from these capex, high capex spenders. So in Europe, very similar story as well.
Yeah, big questions for the second half. Lale, Akoner, global market strategist at eToro, thank you so much for joining our show. And coming up, President Trump says his Board of Peace has received about $17 billion for Gaza. More details next. This is Bloomberg. Good morning and welcome to The Pulse. I'm Joanna Versace in Dubai, and these are your top stories. Oil hits a 6-month high and stocks edge lower with risk sentiment hit by escalating tensions in Iran. U.S. President Donald Trump says Tehran has 15 days at most to reach a deal over its nuclear weapon program. And Washington has carried out the biggest military buildup in the Middle East since 2003, before the invasion of Iraq. And Britain records its biggest monthly budget surplus on record, providing welcome relief for the Chancellor, Rachel Reeves. President Donald Trump said his Board of Peace has received roughly $17 billion in pledges towards humanitarian and reconstruction efforts in Gaza. Trump made the announcements during the group's first meeting in Washington. He said the U.S. would contribute $10 billion, which was a small price to pay to secure lasting peace.
The United States is going to make a contribution of $10 billion to the Board of Peace. Thank you. And we've had great support for that number. And that number is a very small number when you look at that compared to the cost of war.
Well, we're joined by Bloomberg senior Middle East reporter Sam Daher. Sam, so this inaugural Board of Peace meeting took place yesterday, typical Trumpian event. Maybe just walk us through some of the highlights. Who was there and also who was not there?
Absolutely. I mean, obviously, there was a lot of pomp and circumstance and razzmatazz, as we say. Trump spoke for almost 47 minutes and calling out all the leaders that were there. Obviously, there were notable absences from the European side. We only had Bulgaria and Hungary, who have become members of the Board of Peace. The European Union sent an official as an observer. So that tells you a lot. I mean, one analyst I spoke to said Trump, in a way, this peace board is a way to ally with so-called middle powers like Turkey, Saudi Arabia, the UAE, and others to work outside the UN system, which his administration believes is broken, to try to resolve some of these intractable conflicts. Chief of them, the Arab-Israeli conflict.
Yeah, well, the UN have estimated that reconstruction costs could get up to about $70 billion for Gaza. Yesterday, an announcement of up to $17 billion. You say that is one of the big takeaways from this, and that they did secure some pledges?
Right, and obviously the announcement on the International Stabilization Force, the ISF. You had countries like Indonesia say they'll send 8,000 soldiers potentially, and others also pledging to send forces. And also there was an announcement that a police force in Gaza is being constituted. This announcement was made by Nikolai Mladenov, the High Representative for Gaza, and he said 2,000 people have signed up already. But the biggest question here is, and whether any of this moves forward, including the ISF. I mean, no country is going to send their forces until it's clear how the disarmament of Hamas is going to play out.
Exactly.
And Israel has said Hamas has 60 days to disarm, right? So I think reconstruction, sending the ISF, even getting the body that was formed, headed by Dr. Ali Shah, that's now in Cairo, to actually move to Gaza to administer the day-to-day affairs. I mean, all of that is tied to how things are going to be resolved on disarmament.
Yeah, ultimately, that's a sideshow compared to the bigger task at hand, which is that question of disarmament and a big focus of Israel. Sam, thank you so much. That was Bloomberg's Sam Darir on Trump's border peace. Now, in the last couple of minutes, we also got some breaking data coming through from the UK. So also PMIs. The UK composite PMI has risen to 53.9. That is versus the forecast of 53.2. That's a composite number. And a lot of that was driven by the manufacturing figure, which rose to 52 versus the forecast of 51.5. But the services PMI figure in the UK actually fell to 53.9. This is versus the forecast of 53.5. So actually still a beat versus expectations. And those are the figures that are coming through from the UK. When we also had European PMIs just a short while ago as well, indicating a better number than what had been priced in. Now let's talk about the U.S. trade deficit. It hit $901.5 billion in 2025, one of the highest levels since 1960, as a year of aggressive tariff policies led to volatile swings in imports and exports. Now, while the gap with China narrowed to a 20-year low, the deficit widened with Taiwan to a record. For more, we're joined by our trade expert, Brendan Murray. I will say, Brendan, it was surprising to me when I saw these figures, just how wide the trade deficit still actually is. And you would think that maybe U.S. consumers would have modified behavior on back of the tariffs. That doesn't appear to be the case. So what did drive the trade deficit to these levels?
Yeah, I think there were two main takeaways. The first one is that President Trump's tariffs on imports are shifting trade flows rather than shutting them off. And you can see that with the different trade relationships. The bilateral trade with China is way down, but it's way up with Mexico, for instance. It's way up with Vietnam and Thailand. The other issue is there are a lot of imports that are exempted from tariffs, and those include computer equipment, chips, and things that are fueling the AI boom that are coming from countries like Taiwan. So there are holes in the tariff wall around that President Trump has built around the U.S. economy, and yesterday's report showed us exactly where those flows are shifting around and what goods are still allowed to get into the U.S. tariff-free.
But ultimately, has there been a rerouting of trade away from China? Is that showing up in the data?
It absolutely is. You can look at the situation with Mexico, for instance. Mexico's trade balance with the U.S. is going to turn into, it's going to surpass China's in the next couple of months at the same pace in terms of the imbalance. And so a lot of goods, a lot of Chinese companies have set up operations in places like Vietnam, Thailand, and Mexico. And those goods are being, as the Trump administration would say, transshipped, as in rerouted around tariffs. And so that is definitely one thing that we're going to see. And the Trump administration has said that they want to crack down on, and they're trying to do that with a lot of these bilateral trade deals that are announced, like the one with Indonesia yesterday.
Yeah. Another thing that's sort of been hanging over markets, we've been waiting for weeks now on this Supreme Court decision on the legality of Trump's tariffs. It could come today. It could come in the next couple of days. What are the Trump administration's options should the tariffs be deemed illegal?
Yeah, this next opportunity comes at 10 a.m. New York time today, and we'll see if the Supreme Court has the nerve to announce its decision before the President's State of the Union. The administration has said if the ruling goes against them, they will immediately put other tariffs in place using other authorities. Those options include the main one, at least, it would be a tariff of up to 15%, but it will only last for 150 days. So the administration, if it loses this case, is going to be forced to pull together this patchwork of tariff authorities to try to replace the sort of broad tariffs that the president has rolled out since April of last year.
Brendan, thank you so much. And I'm sure we'll come back to you once we actually do get an opinion from the Supreme Court. Brendan Murray. Well, U.S. Ambassador to the EU, Andrew Puster, called Western reliance on China for critical minerals a major supply chain risk. Speaking to Bloomberg, he also said relations between the U.S. and Europe were improving despite recent tensions over Greenland.
It's improved a lot since Davos. We're working together on a critical minerals deal, which both the Europeans and the Americans recognize is essential. If we're going to go forward with an AI economy, we need to work together on that. We've got the trade deal coming up in front of the Parliament the week of March 9th in Strasbourg, and we're very hopeful that that's going to get passed and we can move on with the trade deal, which is so important to transatlantic prosperity, both in the United States and in Europe. And the Denmark, Greenland, and the United States are now negotiating a solution to what happened in Greenland. I think everybody's happy about that. I think people are ready to move on and ready to focus more on things that are going to have a material economic benefit going forward.
And I know that's something that you've been very focused on, whether it's on the trade deals, also this conversation now accelerating around rare earths. How do you see that evolving in terms of a point of overlap between the EU and the United States and trying to get sort of secure lines for those rare earth metals, particularly in the context of China? Is that something that you see progress being made on, and can you sort of elaborate on that progress?
Yeah, I think they made very, very significant progress at the Secretary of State held a ministerial in Washington, D.C. about a week ago. The European Union Commissioner Séjourné attended and made very, very complimentary remarks. The Secretary of State likewise made very complimentary remarks. All of the countries that were there realized that the West is going to be at a severe disadvantage if it doesn't have access to the processing and mining of these critical minerals on its own, where it has to be dependent on China. That's a huge supply chain risk. Everybody agrees on that. Now we need to come up with the agreements that'll solve that problem.
That was the U.S. Ambassador to the EU, Andrew Puster, talking to Oliver Crook. Now, the threat to annex Greenland has intensified doubts about the integrity of NATO. And in this week's Bloomberg Originals documentary, we take a closer look at the president's public justifications for the proposed U.S. land grab.
For decades, a 1946 U.S. offer to acquire Greenland from Denmark was a state secret. The exact offer is unknown, but U.S. diplomats had previously floated a price of $100 million in gold. But it was a non-starter. Greenland was not for sale. Sound familiar?
We need Greenland for national security. One way or the other, we're going to get it.
President Trump plans to buy Greenland. Is that how this ends?
It wasn't. But even if it had, how does one price an island that you think secures a hemisphere?
What is, for example, the value of being able to stop a missile before it hits New York City?
While the security rationale seems to be quite strong, the economic case is not so clear.
In the end, Trump relented, and many pointed to a 1951 agreement with Denmark that already gives the US wide military access to Greenland. But then again, few ever believed the issue was really just about security.
It's clear that President Trump wants to recreate the sphere of influence of the United States over the Western Hemisphere.
Greenland is very keen to do more business and trade more with other nations. At the moment, most trade goes through Denmark.
Back in 1946, at least one answer to how much is Greenland worth was $100 million. Today, it's basically more money than you could print.
And you can watch What's the True Value of Greenland now via the Bloomberg terminal. Well, Andrew Mountbatten Windsor, former prince and brother of the UK's King Charles, has been released under investigation after being arrested on suspicion of misconduct in public office. The arrest came after further details of his relationship with convicted sex offender Jeffrey Epstein emerged. Mountbatten Windsor has consistently denied any wrongdoing. Let's bring in Bloomberg's Michelle Hussein. Michelle, talk us through the latest regarding this investigation.
Well, Jumana, as you say, the former prince was returned home last night, UK time, after essentially spending his 66th birthday with the police. The allegation against him, the arrest was made on suspicion of misconduct in public office. And while we don't know the details of what the police are looking into, the broad assumption is that this relates to the former prince's time as a UK trade envoy and what appeared to emerge from the Epstein files, that there were confidential documents that he appears to have passed to Jeffrey Epstein. Those were documents that came to him through his role, essentially details of investment opportunities and reports on visits to different parts of the world that he had undertaken. This morning, as things stand, there is a search that is continuing on in the Windsor area at Royal Lodge, which is the property that he lived in for many years and which essentially his brother, the King, forced him to move out of just in the last few weeks, which is why he is currently living on the King's private estate at Sandringham in Norfolk in the east of England. Essentially, this is an ongoing investigation, but there are no charges at the present time.
And Michelle, what does this arrest and the investigation mean for the royal family?
Well, it's worth remembering that the former Prince Andrew has always denied any wrongdoing in association to his relationship with Jeffrey Epstein. But this does put the royal family into difficult and uncharted territory. However, after news of the arrest came yesterday, they made choices, and you can see that most clearly in the statement that was released in the name of the King himself, which essentially, when it referred to Andrew Mountbatten Windsor, made no reference to him being his own brother, to being part of his family. It said that he learned of these events with the deepest of concern. Some of the crucial lines, I think, was where the King said in that statement, "Let me state clearly, the law must take its course." And also right at the end where he said, "My family and I will continue in our duty and service to you all," essentially separating him and the immediate family from Andrew Mountbatten Windsor. And that, in essence, is part of a distancing that has been continuing for some years now, including during the reign of his mother and Andrew's mother, the late Queen. She was the one, after he gave a disastrous interview to the BBC in 2019, who removed his royal patronages from him, who said he couldn't wear military uniform in public anymore. Nevertheless, when she died, one of the ceremonial occasions was a vigil around her coffin, and Andrew, alongside his three siblings, were part of that. The four of them stood at the four corners of her coffin as the public filed past. I remember commentating on that occasion at the time. So there has been a distancing, but still, where things stand now is at another degree entirely. He does remain eighth in line to the British throne, and even while that is largely symbolic. He's down below Prince William and his children and Prince Harry and his children. Nevertheless, that remains part of his status. So there's an interesting question about whether the UK government, in association with the monarch, takes steps to change that.
Yeah. Michelle, thank you so much. And also, just to note that Michelle Hussein also has a special podcast out looking at the arrest of Andrew Mountbatten-Windsor. That is available now if you want to get more details. Well, coming up, with award season in full swing and Warner Brothers acquisition talks still ongoing, we discuss the future of the entertainment industry with the CEO of cinema group Vue. That's next. This is Bloomberg. Netflix co-chief executive Ted Sarandos says the company's planned acquisition of Warner Brothers Discovery will lead to more films in theaters, addressing a key complaint from Hollywood. Speaking to Bloomberg, Sarandos said that Netflix promised to keep Warner Brothers films exclusively in theaters for 45 days.
Our pitch is very simple because it's the truth, which is we're going to keep Warner Brothers running pretty much like they are today, releasing their movies in theaters for the traditional 45-day windows. And in fact, it's even quite better for theaters because now that we're going to be in that business and own a theatrical distribution entity, we're going to take some of the Netflix films and put them through that as well. So it's very likely that you'll have even more outcome of high-quality films for the theaters if this deal goes through.
That was the Netflix co-CEO Ted Sarandos. Now, joining me now to make the case for in-person cinema experiences is Tim Richards, the founder and CEO of Vue Entertainment. Really good to have you with us. And of course, looking ahead to the BAFTAs this weekend. But let me just start with the landscape because it's becoming increasingly competitive. You've had for several years now a big push from the streamers. Quite simply, how do you stand out?
Well, I've never really looked at what happens in home, terrestrial TV or streamers as being competition. Our competition is out of home entertainment. But in terms of standing out, we have to kind of constantly reinvent ourselves. We have to constantly innovate, trial test, and make sure that we give our customers the very best possible experience. We've been testing and trialing now for the last 18 months in particular in this post-pandemic, post-strike era. And just in the last 18 months alone, we have rolled out approximately 40,000 leather recliner seats. We've constructed a brand new seat with integrated wine coolers and champagne coolers. And we've also completely gotten rid of our concession stand and put in a completely free area, which has got merchandising, it's got healthy food options, it has traditional concession fare, and it has hot nibbles as well. It's been an absolute game changer for us.
Yeah, interesting. So it looks like you're leveraging that premium experience, which presumably is higher margin as well. What's the consumer uptake been like?
Well, it's been really interesting because particularly on what we're calling View Your Way, which was where we have, our goal was really focusing on our customer's journey from car seat or from bus seat down into our cinema seat. And we wanted to completely eliminate queuing, completely eliminate lineups, and we have. We have gates at the entrance, and we have this free flow right through to where you can pick up, you can see here in the picture, you can pick up whatever concession products you would like. And the consumer reaction has been extraordinary. What we were not expecting, we were expecting to have higher spend, which we have. We were not expecting to get additional growth. And our cinemas where we've introduced this concept, we're seeing massive growth in attendance, and it can only be explained by primary demand growth. And that's really what we're seeing. So our existing customers are going more often, but we're also seeing growth that we were not expecting. So it's been a big win all around.
Yeah, what about the uptake from Gen Z? Are they actually showing up to the movies, or is this a generation that prefer to sit at home and browse TikTok?
And that is the common thinking. Gen Z and particularly kind of the emerging Gen A as well have walked away. Nothing could be further from the truth. 25 saw a 25% uptick for Gen Z in particular. And you can see Gen A kind of sneaking in there as well. And I think part of the reason for that is this is the generation or generations that were mostly affected by lockdown. This is a generation that were at an age where they should have been out with their friends doing silly things, and they weren't. And once everything came out in the post-pandemic period, they were more social than previous generations. So they are our future, and that's why we're excited about welcoming them in. And they've been setting records with some of their movies, whether it be, on the younger side to Minecraft to horror films, which have been really over-indexing.
So interesting what you're saying about Gen Z. Look, I want to go back to something that you said at the beginning about the streamers. And I do want to bring this into the conversation because there's this ongoing bid for Warner Brothers and Netflix emerging as a major player there. What does this tell you about the state of the industry and the fact that Netflix does actually have so much clout?
Well, I mean, it's interesting because Warner Brothers is this iconic studio. I think everyone's a little bit nostalgic about, the best option here is for Warner Brothers not to sell. It is going to sell, and it is going to absolutely sell to either Netflix or to Paramount. And that's kind of the situation that we're in right now.
Okay. Looking ahead, I mentioned that the BAFTAs are coming up this weekend. What does the award season, the shortlisted films for the BAFTAs tell you about the consumer watching habits and the types of films that are resonating these days?
Well, I mean, what's really exciting about what's happened in the last year in particular is that we've broken records now for every genre of film, for every demographic. And, you can see when movies like Wallace Island or I, Liar there's really kind of over-indexing, and it's that full range all the way up to Minecraft and to Zootropolis, which broke records, broke a number of records. So I think when you have a movie like Hamnet gross the way that it did, it's really a good indication of what to expect for the next few years in the industry.
Tim, a real pleasure to chat to you. Thank you so much for coming on The Pulse today. Tim Richards, founder and CEO of Vue Entertainment. And a look at U.S. futures before we head out for the weekend. Some big data dropping in the U.S. in the next few hours. The PCE data, personal income, spending, GDP, all of that to watch out for. But I guess the big focus for markets is going to be what happens in the region with those reports of the U.S. amassing a huge armada around the Persian Gulf. And we'll see how things unfold over the course of the weekend. Geopolitics in focus. But coming up next is Bloomberg Brief. This is Bloomberg.